So today we're going to focus on provisions, contingent assets, and contingent liabilities. Okay. So any kind of provision, contingent asset, and liability comes down to our basic accounting principles. Okay. Now let's understand first what is a provision for any kind of concept that we are going to study. Please remember in accounts, everything comes down to three pillars. It's measurement, it's recognition, and it's disclosure. Correct. So therefore, if you answer the what, why, how, when of accounts, then you are comprehensively clear of what the concept is. Okay. So let's understand first what is a provision and why is a provision recorded separately from a liability. Okay. So let's start with what is a liability. Can any of you, I know this is very basic, but can any of you tell me what is a liability? So a liability, as you correctly said, will lead to an outflow of a resource, outflow of some cash, and it is an obligation that we have to pay. Okay. Now, for a liability, if I have to ask you, a liability has certain timing, certain amount. What about it? A liability has both timing, which is certain, and amount, which is certain. Correct. To give you a very simple example, you have taken goods from a supplier on credit. Correct. You know that you have to pay in 45 days. So therefore, your payment obligation will come before or on 45 days. The timing is certain. Correct. Secondly, you know you have to pay 10 lakhs because the purchase amount is of 10 lakhs. So the amount is also certain. So liability is recorded when both the amount is certain as well as the timing is certain. As far as provision is concerned, either a timing is uncertain or an amount is uncertain, or both are uncertain, which makes a provision different or distinct from a liability. If you don't know when you have to pay, or if you don't know how much you have to pay, or if you don't know both of it, then you end up recording a provision. Correct? A provision is also recorded in the financial statements, as you know, in the profit and loss as well as a balance sheet. But here is where a provision gets distinct from a liability. Okay. Now, I will give you a few examples of provisions, and you tell me what of it is uncertain, whether the timing is uncertain, whether the amount is uncertain, or both of it is uncertain. Okay. Now, we have first, which is, let's take this very simple warranty provision. Correct. All of us may have taken the benefit of warranty or definitely know about the warranty provision. So we have warranty on, let's say, cars, we have warranty on mobile phones, vehicles, etc. Correct. Electronic goods. So can you tell me, in a warranty provision for a company, is the amount uncertain or is the timing uncertain, or both? Third example I would like to take is of gratuity, or we can take a simpler example like a court case. If we have a legal case, let's say an employee has sued us, or let's say there is some environmental damage or labor laws that under which the company is sued. So in this case, what is uncertain? If I can hear from Adarsh or Niranjan, is the amount, is the timing, what is uncertain? Perfect. We don't know how many days, weeks, months, years the court will take to give its order. We don't know how much penalty the court will charge or it may not charge. So in this case, both are uncertain. So that is why a provision, we have taken examples to see that amount, timing, or both. Clear? Okay. Now, continuing with our case, then how do we recognize a provision? As I said, we have to answer why, what, how, when, if, etc. So we record a provision when there is a present obligation because of past events. Let us take our examples. Tata Motors or Maruti Suzuki has sold a car and given you an embedded, which means an already included warranty of 1 year. Correct? What is the past event here? Tata Motors selling the car. Correct? So because Tata Motors has sold its car, we know that it has an obligation to give you that free repairs or nominal charges repairs for 1 year. Correct? So Tata Motors definitely has a present obligation because of past events, right? It is probable that the resources are going to be spent. Of course, let's say your repairs cost 20,000 and let's say you have to bear 4,000. 16,000 are not going to be free. The repair guy is not going to give it for free. Tata Motors has to bear it. So of course, there'll be an outflow of economic resources. Now, the main question is that if the amount is uncertain, then how do we record a provision, right? So a provision is recorded on the basis of a reliable estimate that can be made. Okay. So for example, in case of warranty provisions, if I can ask you, how do we make a reliable estimate?
Based on the past experience.
Excellent. We know approximately how many percent of customers will come. We know approximately how much percent of charges have to be paid. So past trends are an indicative for warranty provisions, correct? If I have to ask you a legal case, of course, legal case, hopefully the company won't have past trends, right? So how can a provision be made? How can a reliable estimate be made?
Based on the lawyer discussion, it can be only contingent in the footnotes, not
Fantastic.
in the statement
So,
itself.
based on the lawyer's estimate, based on some calculations or some estimates that we do, we can have a provision that is made. Correct. So, a provision is recorded only when all of these aspects are ticked. Right. If any of these are not met, we'll study it later. But a provision drops down and becomes a contingent liability. Correct. I know that all of you are industry experts, so therefore I would like to incorporate as many industry examples as possible. We have an IndusInd example here. And can any of you tell me why have I taken it under the provisions case? What happened with IndusInd that made it include here? So IndusInd had two problems between the approximately March 24 to September 25 range. What had happened is that it was facing a lot of stress on its microfinance loans. There were a lot of recovery problems, a lot of aspects relating to NPAs relating to microfinance loans. Second important is that the internal audit marked a very big discrepancy in the IndusInd case. The interest that they had recorded had a 674 crore discrepancy. Okay, because of this, there was a obligation for the company to pay to the interest holders, and they had to mark a provision. Okay, I've taken a screener link here. Let me just open it. Yes. So as I said, this timeline was between March 24 and September 25. Now, the problem with Screener is that it does not record provisions separately. So we have to search it under the other liabilities. Okay. Allow me to show you where the change can be seen. Okay. Now, as you can see, between March 24 and September 25, if we see the other liability items where generally provisions are recorded, there has been a significant jump in the other liabilities, correct? We have 18 to 23 to 27,000, which is because of their discrepancies in the microfinance loans as well as the interest recording. Okay, so that is how we can see a prominent case of a provision being recorded in a banking sector because of any kind of any kind of regulatory issues or any kind of discrepancies that was recorded. Going ahead, right now, this is interesting. Not all provisions are the same. Okay, there are two kind of provisions that I want to discuss here. First of all, let's start with a simpler one. Let's say provisions that arise because of laws and regulations. Okay. Simple examples of this is provision on gratuity because it is because of a legal provision, or obviously provision due to a impending court case that a company is going through. Correct? That is a legal provision. Second is a constructive provision. A constructive provision is made, a constructive obligation is because the company has certain policies and practices. And because of this, the company voluntarily is taking upon itself decision to create a provision. Okay. So there is no legal obligation. There is no necessity to do this. But the company on itself is saying that I want to create this provision. Okay. Now, I want to ask you two questions. If I ask you, where will warranty provision come? Will it come under constructive or legal?
Constructive.
Okay, so warranty provision seems under constructive, but warranty provision actually comes under legal. Okay, because we have made any kind, it is binding on the company to give it under the legal obligation. Okay, so a simple example of a constructive would be add-on employee benefits. Okay, I'll give you an example. Both my parents have been ex-SBI employees. And I don't know if you know, but SBI has a policy that even if you retire or if you're working, all its holiday homes and guest houses are given to the employees at a very nominal or a discounted rate. So, for example, if a hotel room costs 5,000, the employee gets it under 500 at a very nominal rate. So, the additional 4,500 is obviously borne by SBI. Now, this is a provision that you have to make. Is it binding by law?
Yes.
How is it binding by law? See, the law has not asked SBI to give concession to its employees, correct?
But they have if they have committed something, and it's like employee itself, like employment itself a legal term. So if something coming in terms of the employment, every conditions will be applied, and that will be legal.
Perfect. See, I give you a distinction between this. If, as you're saying, for employee benefits, if it is gratuity, is there a legal provision for it? Is there a law for it?
Yes.
Yes,
There is
perfect.
law.
But if the company is giving concessional hotel discounts or concessional hotel accommodations, restaurant accommodations, is that a legal obligation or is that an obligation taken by company in itself?
Company itself.
Company itself. Yes.
Exactly. So that is why it's a constructive obligation, correct? So my example comes under constructive obligations. These are benefits that the company has decided we want to pamper our employees. It is not binding by the law. That makes it a constructive obligation. Okay. But whenever there is a legal obligation for it, that makes it a legal obligation. Here we have taken a Vedanta case. Is anybody aware of the Vedanta case?
No, ma'am.
Okay.
No.
Vedanta had a plant in Tamil Nadu, which which had come under fire for violating the environment regulations. Okay, the court case has been continued from 2018. So I'm going to take this case under contingent liabilities as well. But finally, the court case verdict came in February to March 2025 against Vedanta, resulting in Vedanta needing to pay a fine for that plant. Okay, so therefore, if we quickly see the screener example for Vedanta, it's very clear that Vedanta has a significant rise in provisions during that period. Okay. Allow me to take you under the balance sheet. We see other liabilities, yes. So as I said, the court case verdict came in February to March 2025. And after that, between the March 25 and the September quarter, if we can see the other liability items, the other liability items have jumped from 39,000 to 65,000. Okay. The notes to accounts give an explanation that there's a significant rise because of the court case provision that they had to make. Okay. So in case of Vedanta, this was the clear legal obligation that we can see. Now, obviously, all of us are aware of the ongoing, or if I can say, the recent past Indigo issue. As you know, Indigo had clearly mentioned that they would give full refund to customers without any questions asked. If I ask you, is this a constructive obligation or a legal obligation?
Constructive.
Okay. Under the, I think DGPA, if I'm not correct, under the rules and regulations, any kind of cancellations, any kind of abrupt change in the flight schedule from the company side has to be refunded to the customers. That's a clear policy given by the government. Okay. So now if I have to ask you again, where will it fall?
Then it's legal because that's a policy.
Legal.
Very
Policy,
clear
yeah.
legal obligations. But if I have to ask you that Indigo has, let's say, I'm giving you an example that Indigo has mentioned that for the next flight, we'll give you a complimentary meal, or for the next flight, we'll give you 1,000 rupees discount. Then that is a
That's a constructive.
fantastic. Then that is a constructive obligation. The government is not asking you to do this, but you, in order to protect your brand image, protect your goodwill, have gone out of your way and promised something to your customers, which comes under constructive obligation. Okay. If you remember, the CEO had given a full TOI first page print that we are sorry. So these are efforts that are taken by the company to protect its brand image. Okay. Yes. Now, how is a provision recorded? We have already mentioned this, but we'll quickly sum it up. If it's a single obligation, can you tell me an example that we have taken of a single obligation? So far in our examples, we have covered Tata Motors, we have covered Indigo, we have covered IndusInd, and we have covered Vedanta. What if it is a single obligation? Okay, a single obligation is a one-time payment. So I ask the question again.
Indigo, like we have to just pay once.
You are right. In a certain aspect, Indigo was one time, but I mean literally one time. So can I say Vedanta, singular court case, one-time payment, correct? Hopefully the incident won't repeat. Vipin, in your example, Indigo definitely has a one-time payment, but it is to a large number of customers, correct?
Okay, yes.
Yes, correct. So an expected value for a large population of items. So your answer comes of Indigo comes here, as well as simple cases. If I've given a warranty, this month Tata Motors has sold to 2 lakh customers. Then out of this, it's a large population, and Tata Motors will guess how many customers will come back, claim the provision, etc. Okay. So that is an expected value, as we have discussed. Vipin, you have already answered perfectly. That depending on past trends, we'll make an estimate how much provision we have to make. Okay, now I've taken this example from the SBR textbook. It's a very simple example. I want you to quickly read it once and give me the answer. So, very simple example. Just have a look and tell.
The company have to make the provisions for around 2,000 pounds, and that will be, I think, segregated throughout the year.
And what is the amount of warranty that we can show here?
Also, it's 14 to 50, around 2,000 pounds overall.
So, how did you calculate this? Sorry, we have 200 machines at 50. So, we have sold 10,000 worth. And then?
I have to, we have sold 200 pieces. So 20% will come back. So 40, the quantity is 40.
Into 50.
And 40.
Fantastic. So 2,000, perfect. 2,000 will be the amount of warranty, correct? One more important thing is that time value of money has to be taken, very important, especially in longer time provisions like gratuity or warranty of 5 years, 10 years, then if you estimate that you have to pay 12,000 after 8 years, what will be its value today? Okay. Since all of you have exemptions, I don't need to explain NPV and present value. Okay. But time value of money has to be considered, right? Can we go
Mm.
ahead? Everything good so far?
Yes.
Okay. How to account for provision? Again, very basic. Let us quickly run through it. Okay. Now, a provision for labor expenses, if let's say it's a provision for labor expenses, then we go into the P&L, we record it in debit. I've taken an example of 16 lakhs, and correspondingly, as we know, it's a dual effect. So we record a liability in the financial position of 16 lakhs, correct? Now, if I have taken a present value, that is, if I have taken it discounted to present value, then the finance cost also has to be unfolded. Okay. So to give you a simple example, let's say, let me open my Excel. Let's say the future cost is 20 lakhs and the present value is 16 lakhs. And the finance cost, let's say it's a period of 4 years. So the finance cost every year is 1 lakh. Okay. This is very simple just for understanding. So every year I have to unfold the finance cost as well, right? So finance cost will go in P&L, 1 lakh every year, and correspondingly my liability will increase every year in the balance sheet, 1 lakh. So now my liability becomes 17 lakh at the end of next year. At the end of next year, it will be 18 lakhs, so on and so forth. Okay. This is how we record a provision where time value of money will be unfolded. Okay. Now, interestingly, provision will be de-recognized as well. When will the provision be de-recognized? By the common sense, we record a provision simple when we expect that we have to pay money. If we expect that money does not have to be paid any longer, we de-recognize a provision. Okay. So therefore, a provision is de-recognized when it is expected that no longer an outflow has to be made. Exactly opposite effect will be given. The provision in liability will be debited and it will be credited in P&L. Okay. I'm not going into the in-depth of accounts. I hope that's okay because debit credit, I know you all are well versed with. So I hope that's okay. Right. Okay. I've taken an example of Piramal Enterprises again. Let me explain you what Piramal Enterprises example was. It's an interesting example where a provision was recorded and thereafter de-recognized. Okay. In I think December of 2023, about that time, November, December of 2023, RBI had made the provision on AIFs, which is alternate investment funds, very stringent. And because of which Piramal did not comply or was not able to be in line with those regulations, and therefore heavy provisions needed to be made in the December quarter for Piramal. Okay. So therefore, if we see Piramal unfortunately has only yearly balance sheets in Screener, but I'll be able to show you in the net profit. Okay. So we can see that the net profit was significantly affected. Now in January 2024, RBI relaxed its provisions. It made it much more lenient, which is why Piramal again fit into the regulation. And that is why Piramal de-recognized its provisions. Okay. So if you can see the shift, again, there was a significant increase in the net profit. Now, you may have this question, and it's a very fair question that net profit is affected because of many things, not necessarily a provision. But if you check the notes to accounts in the same year, you will get a corresponding proof of that. Okay, due to a lack of time, I'm not going into the notes to accounts, but you can see the correspondence event of it, evidence of it. Okay, we'll quickly see the Piramal case in this instance. Yes. So if we check the net profit, I had quoted you 23 and 2024, right? So I think in February 2024 also there was a major event, but let's check the timeline for balance sheet. Yes. So the profit before tax had reduced significantly, and you can see a major shift in it in the immediate next quarter. Now, obviously, the operations won't change to such a big degree because if you can see the revenue has pretty much remained consistent, correct? So it indicates, as well as the notes to account suggest, a de-recognition in the provisions in the immediate next quarter after RBI relaxed its provisions, because of which the net profit before tax has jumped a lot. Okay. So this is how the provision is de-recognized and how it affects the profit and loss as well as the balance sheet. Okay. Recognition as well as de-recognition we have covered. So that concludes our discussion for the provisions. We have discussed why provisions are made. We have discussed on what provisions are made, how they are recognized, how they are disclosed, etc. Okay. Let's go ahead. The next aspect which we are going to discuss is a contingent liability. Now, both contingent liability and contingent assets work on a fundamental accounting concept. Can any of you tell me that concept?
Based on certainty or uncertainty of the particular event happening in
Absolutely.
future.
Can you tell me the name of the concept? though? You are correct, but can you tell me the name? Anyone, others, Niranjan?
Based, like it's based on probability.
Based on probability. Okay. I can give you a hint that the first alphabet is correct. It's based on a concept starting from P. Okay. Accounting concept of prudence. What does prudence mean? Always record for upcoming possible liabilities, but be very cautious when you record for upcoming possible gains, correct? So record for losses, but do not record for gains. I did a lot of search, and I'll tell you a proof regarding this. Did a lot of search on contingent liabilities in company, contingent assets in companies. I could rarely find a case or two. But when I search for contingent liabilities, I could find multiple cases, correct? So it tallies with a prudence concept where record for upcoming losses, but be very cautious if you want to record for upcoming gains. Okay. Now, a contingent liability, as you know, is not recorded in the balance sheet and P&L because of the obvious reason that the name suggests itself contingent. It's not a liability for sure, and it's not a provision as well. See, what is the difference between a liability, a provision, and a contingent liability? Now, I have told you the difference between liability and provision. Can you tell me the similarity between liability and provision?
In terms of liability, we are very clear, like on this particular time or within this date, we have to clear the liability. In case of provision,
Perfect.
we have the certainty, certain certainty, like more than 50%, but not very accurate.
Yes. So, Bipin, you're right that the amount and timing we don't know, depending on case to case. But if I have to ask you, what is the clear similarity between those two?
Both will be recorded in the financial statement.
Yes, correct. But as a concept, what is the similarity? Okay. So, do we agree that in both provision as well as liability, we have to pay money? So, there is an outflow, correct?
Yes.
Yes. Provision, we don't know when, we don't know to whom, we don't know how much, but we know we have to pay. So both provision and liability definitely have an outflow of resources, correct? That is a common aspect. But in contingent liability, we are not even sure whether we have to pay money or not. That is why it's a contingent liability. That is why it is only disclosed in the notes to accounts. Now, if I have to ask you, why disclose it at all? Yes, prudence for sure. But if I have to ask you from a financial markets point of view, why disclose a contingent liability? Does anybody even read notes to accounts? What is the significance?
Yes. So first concept true and fair view. So if we don't disclose everything, the first concept will get hit.
Yes, correct. Absolutely perfect. See, contingent liabilities are basically to make the shareholders prepared that listen, a liability may be upcoming. Don't get panic when you see a sudden liability coming, जैसे कि वेदांता के case में हुआ, that there was a huge increase in provisions in a quarter. So don't blame us and don't tell us that we did not give you an indication beforehand. We have recorded in provision in notes to account right when we got to know about it. Okay. So that is why a contingent liability is recorded, and people who are serious investors will always look for it. Okay. Now, let's understand when a contingent liability is recorded. There are two of these cases. I've made a table, and I hope the table will be clear enough for us to understand. Okay. So, an obligation is possible. It is very important that the word possible is used. For provision as well as liability, the word used is, let's check what was the word used. The word used was present obligation. So, for provision as well as liability, there is a definite obligation. For contingent liability, the word used is that the obligation may or may not occur. We are not sure. Okay. Based on past events. Kuch to hua in the past, that is definitely led to this obligation. Correct. Now we don't know whether we have to pay or not. The existence will be confirmed by future uncertain events. Do we have to pay? No, we are not sure of that as well. Can we control it? No, we can't control it. So pretty much nothing that is going to go ahead, that is going to go in the future is in the company's hands. Therefore, a provision is recorded. Okay. In all the examples that we have discussed so far, can you give me an example of a contingent liability that we came across? We discussed Indigo, we discussed Vedanta, we discussed IndusInd. So can I, yes, Niranjan, you were saying?
So for Indigo, there could be a class of action of suits, right? Because of what has happened.
Right.
And the company's management or leadership can take a proactive stand of taking some sort of contingent liability or declare it.
Right. But Niranjan, as far as the refunds are concerned, is it a possible obligation or a present obligation?
No, that's it's not for refund, but it could also come beyond refund.
Future. Correct, correct.
So,
Correct.
as you rightly pointed out, refund is a obligatory one, right? They have to. But
Correct.
apart from refund, there could be a lot of other damage that might have happened to companies, individuals per se. So
Absolutely.
we don't
That's
know
a great.
what it could be or how it could be. It is open to interpretation.
Absolutely. That could definitely be a possible obligation. Sounds fair. Absolutely. Okay. The Vedanta case is a very clear example of a contingent liability. Okay. As I told you, the court case started in 2018. Correct. Now, with the possible obligation, yes. Why are we saying it is possible? We may win the case, we may lose the case. If we win the case, no obligation. So possible obligation. Past event, yes. They had a plant in Tamil Nadu, which was caught under environmental violations. Okay, so past event ho gaya. Existence will be confirmed by future uncertain events. What is the future event?
Possible outflow of resources.
Yes, but what is a future event? Whatever is the
Legal-
ruling of the court case is the future
Yes.
event, correct?
Legal court, yes.
Perfect. Do we have to pay? Yes, depending on the court case order. Can we control it? Obviously not. The court has to decide whether Vedanta is guilty or not guilty. So basically, all of this is outside our hands, but we know that the court case is going on. So we need to tell the shareholders and investors honestly that listen, we may need to pay money in the future, really ending up for it being a contingent liability. Correct? I have taken an excerpt of a notes to accounts from Vedanta. This is what the company had disclosed in its FY 23-24 that whatever is the court case narration, and that is why a liability could be recognized. Okay, they've clearly mentioned that a contingent liability also occurs where it is extremely rare cases that a liability cannot be recognized because it cannot be measured reliably. So Vedanta has clearly communicated that they don't know if they will win or not, and they don't know how much they have to pay if they lose. So that is why contingent liability. It's obvious that a contingent liability is very difficult to measure. So therefore, companies may use the most reliable estimate that they can think of, but it's very difficult to measure a contingent liability. Okay. This is one case where a contingent liability is recorded. The other case where it is recorded is where the obligation is there. There is definitely a present obligation because of past events. So something has happened in the past because of which there's an obligation. But we think that we don't have to pay money. So we think that we don't have to, there is no outflow, or in very rare cases, it cannot be measured. But in my professional opinion, I think it cannot be measured is a tool for manipulation. So it may not be the case. The more realistic answer is that outflow is not probable. Okay. And it is within the control of the entity. An example of this is Infosys. Infosys was caught into some tax disputes. Okay. So therefore, definitely there was a notice sent to Infosys. There was a present obligation. Yes. It was arising from past event because Infosys previously had paid tax and because of which there was some dispute. According to Infosys, it had not done any mistake. So therefore, Infosys doesn't think that they have to pay money, and that is why they don't want to record it as a provision. They only want to record it as a contingent liability. Okay. So in such cases as well, we have a contingent liability recorded. Am I able to tell you the difference between both of them? Because this is very crucial. So is it clear?
Yes, it is.
Yes. Fantastic. Vipin, are you with me?
Yes, yes.
Perfect. Okay. So therefore, both of these cases, as it is mentioned, we only disclose in the notes to accounts. Okay. Right. So that sums up our discussion of contingent liabilities. There's not much to discuss about contingent liabilities because it's only a disclosure part. So it does not impact our financials to a significant extent. Okay. I've also given you an example of Vedanta Group and Infosys where there are two different approaches, both of them very different cases, but end up being a contingent liability. I believe we have 10 minutes and I want to discuss contingent assets, but if you want, we can just open it up to Q&A. According to Prudence example, as I said, very rarely is a contingent asset recorded because companies want to be very careful in recording gains, correct? A contingent asset inflow is possible. We don't know whether we'll get money or not. There's certainly a past event. We know that the event has happened. Whether the inflow will happen, again, depends upon future events. Will the inflow come? We're not sure. It's probable. Is it in our control? No, it's not in our control. Okay. So as you can see, a lot of question marks, a lot of uncertainties. So therefore, as the name suggests, contingent. Okay. I'd like to ask you any example that we could think of a contingent asset.
Currently, like Infosys has filed any cases against TCS or anyone.
Right.
So in that
Perfect.
cases, we can just write that, we have some chances that we can win this case. And
Oh,
Fantastic.
it-
So you were saying if you file a case against any other company, correct?
yes,
Good example. That could definitely come as a contingent asset and that meets all the conditions. Will we win? We don't know. The court will decide. Will we get money? No, we don't know. Is it in our control? No, it's not in our control. So all of these are question marks. Any
So-
other example?
tax refund dispute or even warranty reimbursement from supplier.
Perfect. Fantastic. All of the conditions met. Again, a contingent liability, a contingent asset. Sorry. Fantastic.
Avanti, what about insurance claim recovery? If as
Yes,
compared
I was just going to give the example that insurance claim also is a contingent asset. Unless your claim is approved and sanctioned, you can't record it, correct? Perfect. So that is again a contingent asset.
and it could
Okay.
also be a lawsuit, any lawsuit claim.
Absolutely. Bipin has already said absolutely. Lawsuit also comes under a contingent asset. So if I may ask you, When does a contingent asset become an asset?
When there is a probability that we will get money from the suppliers or whosoever.
Fantastic. I'm so happy that my objective is fulfilled. Perfect. When it's virtually certain, and please mark my words, virtually certain is very important. When it's virtually certain that you're going to get the money when there's an inflow, the contingent asset can be converted into an asset. Okay. Let's take an example. This is what Honeywell has recorded in its notes to accounts, but this is only the meaning of contingent assets. That is not an example. Whereas, okay, now this is interesting. CIA is a company, they had a court case. For example, I don't know the exact amount. For example, they had 6 crores initially given, and then it had come down to 1.3, 1.4, whatever. So they reversed the 4.73. Okay. Now, if I ask you, is it a derecognition of provision or is it a contingent asset? Did you get the case?
Contingent. It is contingent, right?
Contingent asset. Okay. Bipin, what do you think?
Yes, contingent.
Okay. According to me, it is derecognition of provision because you had to pay money, right? It's not a gain for you. But CIE has also recorded as a contingent asset. So there is a difference of opinion in this aspect. There's a lack of clarity in this aspect. But the company, as you both correctly said, had recorded as a contingent asset. So this is a rare example that I could find of the same. Okay. Yes. I think I've taken enough your time on Sunday. Let's quickly just sum it up to see the difference between all of them. And I think we can conclude for the day. Okay. Allow me to just open the SBR textbook. This is a good table that I have used to sum up a provision, a contingent liability, and an asset. Okay. A provision, as I've discussed, legal or constructive. Probable outflow can be reliably measured. But the word that we have to focus here is that outflow to pakka hai. We don't know kab hone wala hai, kitne time mein hone wala hai. Yeah, both we don't know, but the outflow is definitely certain. For contingent liability, if we think that the outflow is very remote, most likely 99% nahi hoga, ignore. If we think maybe hoga, possible and probable. What is the difference? Possible is that there are less chances, still record. Probable, more chances. But as I said that we don't know how much is the amount. We don't know that whether court case, we don't know if it will be or not will be. So probable in that case still disclose. An asset, if it is remote, if it is very, very unlikely, ignore it. If it is possible, if the chances are, let's say 30, 40%, still ignore it according to prudence example. But if again, as an insurance case, you're very confident, your documents are clear, you know that you are going to get the claim. If you're very sure about it, if it is 70, 80%, yes, then you can disclose it. Not recorded. When it goes to 100% recorded, but at 70, 80, you can disclose it. So yes, that sums up a discussion for provisions, contingent liability, and assets.